For years, the orthodoxy among fixed-income investors was to stick with short-term bonds and avoid the long-term issues because rates inevitably would go up. Now some people are challenging that point of view. I'm Jack Otter, editor of Barron's.com. I'm here with Mike Aniro, who writes our income investing blog. So Mike, this guy from BlackRock you spoke to, you interviewed him for your column, is making this case to avoid the short end of the yield curve, to use technical bond speak, and go for the longer issues. What's the argument for that? I thought that was the kiss of death to buy these low-yielding 30-year bonds.
Well, if you remember what happened last year when interest rates rose, it affected longer-term bonds, particularly long-duration bonds in bond speak, the bonds that are most sensitive to interest rate moves, which tend to be the longest-dated bonds. So in so doing, you saw a lot of price losses for longer dated bonds, but those price losses sort of have gone through the system a little bit already. Now what you're seeing is longer dated bonds, the yields went up, they offer better yields, which obviously makes them attractive to investors, but at the same time, the Federal Reserve is winding down its bond purchase program, which targeted longer dated bonds. So the Fed is buying less of those bonds. Markets have priced that in. Now markets are turning their attention to shorter dated bonds and to the Fed's ability to suppress short-term interest rates. That's the next big move that markets are expecting from the Fed. And when the Fed does decide to raise its short-term policy rate, that will hit shorter dated bonds the hardest.
So the argument for owning the shorter dated bonds in, say, a bond mutual fund was that, yeah, they'll take a slight hit when rates tick up, but those bonds will mature fairly quickly. They're short term after all, and at that point, you get redeemed at par, you get your full money back, and now you end up with a portfolio that has higher yielding bonds in it. So what's wrong with that argument?
It's still a good argument. I mean, if you're buying into a mutual fund, mutual funds, bond mutual funds, they never mature. There's not a maturity date. So what they will do is they will reinvest bond proceeds when they mature into new bonds. So you are going to take a hit if interest rates go up. The value of that mutual fund will go down, but over time they'll be able to reinvest in new bonds at higher yields, so you'll have to accept a little bit of a price loss along the way, but in the longer haul you'll be getting better income.
Could it end up like Chinese water torture, though, if these bond rates creep up for years and years? Could I take hit after hit?
You definitely could, but bear in mind that there was a 30-year bond bull market that preceded this, so all those great bond returns that you were getting during that period, now is the time, unfortunately, when investors are going to sort of have to pay for that period by accepting some, as you put it, perhaps water torture, whereby each year your bond returns are undercut a little bit by rising interest rates, but over that same time, the yield you will be getting will be going up as well.
So does this argue for owning, rather than mutual funds, just actually the individual bonds? At least I won't suffer the principal loss.
Yeah, if it becomes a tricky proposition. A lot of bond investors often will ladder bonds so that bonds will mature in staggered periods, so that not all of your bonds are maturing at the same time. And you can do it that way as well. The risks are if you don't spread it out enough, that you have a particular maturity cluster, and that eventually rates move in a certain direction. You can get hit that way. As long as you balance it out, it can work to your advantage.
And if anyone needed the money immediately, they could be selling at a loss.
That's right. That's always the risk, and that was the risk last year, is if you sold bond funds at the peak of these price losses, you were experiencing these losses. If you hold on longer term and you have a more balanced approach, it won't hurt as much.
Thanks very much, Mike.